Over the last 2 years, cannabis stocks have really whittled away to almost nothing, erasing 95% of the money that people had invested into them. But in the last few weeks, we have seen these same cannabis stocks catch a huge bid, with Tilray, for example, up almost 50% today alone. Now, if you're like a lot of other traders out there, you're sitting on the sidelines wondering, is it too late for me to get in? And if I wanted to take a bullish bet on the cannabis sector, what is the best way for me to do it? Now, as we all know, when everybody's bullish, prices get inflated, volatility increases, and it can become very difficult to profit on actually placing that bullish bet. So what I'm going to do with you in this video is go over the data points that I'm seeing for a company like Canopy Growth and structure out a trade with you that allows us to take advantage of this inflated volatility and structure a really high risk to reward bullish bet. So if you're new to the channel, my name is Sean Ryan, and my job is to help you go from uncertain market speculation to well-equipped, profitable trading by making it easy to take a quantitative approach to option trading. So if you find this video useful, make sure to leave a like and drop a comment with which cannabis stock you have your eye on. And if you want more content like this, all you have to do is hit the subscribe button and the notification bell. I release videos like this every single week. So let's jump into it. There are many cannabis stocks catching a bid today, including Canopy Growth, Aurora Cannabis, Tilray, and the list goes on. So for this video, we are going to focus on Canopy Growth. But if you're looking at another cannabis stock, feel free to leave a comment down below and I will give you my analysis on that stock. Now for Canopy Growth, we are going to follow a 3-step process for figuring out what trade we should be putting on. Step 1, define my view. What do I think is going to happen? Step 2, see what the market's view is, right? The market has an opinion as well, and that is how the options are actually priced. And step 3 is structure a trade that expresses the difference between my view and the market's view. So let's complete step 1 first. My view is that Canopy Growth will continue to trend to the upside. Now, I don't think we're going to see it move 50% in one day or 20% in one day, but I do think we will see it trend upwards, maybe 10% over the next few days. And for that, we need to look at the data. So I come into the Predicting Alpha terminal, I look up Canopy Growth, and it populates all of this information that I can now analyze. So what I notice right off the bat is the market is implying 91% volatility for the 30-day options. And given our mathematical models, I'm forecasting it to be closer to 74%. So this falls in line with what my expectations are. I think the stock will move up, but what's clear is that the market thinks the stock will move up more than what I think. Meaning if I were to go out and buy a call option, well, I might be overpaying for that option and be correct in my view, but not make money because the market thinks it's going to move more than what I'm thinking. So off the bat, I can assume options are pretty expensive here. So what can I do about it? Well, maybe what I can do is ask myself, are options expensive across the whole chain? Where are they maybe more expensive than in other places? And is there a way I can take advantage of that? And when I scroll down, what I notice is this skew here. Now for this skew graph, we have a couple different things, right? We have the implied volatility on the y-axis, the different delta strikes on the x-axis, and we have 3 lines, the 10-day options, 30-day, and 90-day options. Now I want to be trading something near dated, so let's focus on these 10-day options. And what I can see is that the at-the-money calls, which would be these ones here, are trading at that 93% implied vol. But these out-of-the-money calls are trading at 109% implied volatility, meaning that relative to one another, the out-of-the-money calls are more expensive than the at-the-money calls. This means the market is saying that the most likely move is little to no move at all, but if we get this big move, it's going to be to the upside. The risk for that big move is to the upside, and this is where I actually find my disagreement with the market. I don't think that it has the risk that the market is implying. I don't know if we're going to see that huge 20-30% mover, but what we might see is a move to the upside, right? I think it's more likely that we see a move to the upside than no move at all. And that is my disagreement with the market. So what I can do is I can express that view by doing something maybe like a vertical spread, or what you're going to learn about in this video, a PA fly. which is an unbalanced fly that takes advantage of this call skew. So there we go. I think I have a good idea of a trade I can put on. I'm confident I'll get a really good risk to reward. And if I'm right, it should pay a lot of money. So let's go into my brokerage now and structure out this trade to show you exactly what I'm talking about. So here we are on the option chain for Canopy Growth. Now, since I'm going to be trading the near dated options, I want to be looking at this February 12th expiry. Right? The good thing about Canopy Growth is it's pretty liquid. So these weekly options should have enough liquidity for me to be able to get in and out of my trade. And the first trade I'm going to look at is this vertical spread, the 54-55 vertical spread. So let's go ahead and analyze this trade and see what it looks like. So what we can see here is that we have a really good risk to reward on our hands, right? For 10 vertical spreads here, we're risking $160. If at the end of this week, Canopy Growth is below $54, we are going to lose our money. But if it goes above that $54 mark, more specifically above $55, we are going to make $840. We are getting over a 1-to-5 risk reward on a binary outcome. Meaning, if Canopy Growth goes above $55, we are going to make 500% this week. And we are able to put on this trade for very low risk, right? It's not like we have to put up $10,000 to put this on. We can actually get this trade on for just $16 per lot, right? If I bring this down to a one lot, you can see it's a $16 debit to put on this trade for a potential payoff of $84. So this is the basic way that I would take advantage of that call skew. You're buying something closer, selling something further, which has a higher implied vol. And because of that, you're going to get a bit more leverage than you would normally. But there might be something better. What if we were to structure out one of those PA flies I've been talking about, right? Maybe it would look something like this, right? We'll come here, we'll buy an unbalanced butterfly, and we'll put the strikes at 51, 57, and 60. Let's see what that looks like. Check this out. If Canopy Growth goes below $51 or above $60, we're gonna lose $780. But if it stays between that range and ideally pins at $57, we are going to make a boatload of money. We would make $5,000 on a $7,000 risk. And all we're doing is structuring a trade that expresses our opinion, right? Our view is that Canopy Growth is going to continue to trend upwards, maybe as much as 10% in the remainder of this week. And if that view is correct, we want to get a maximum payout for being right. So what we did is we sold some of the extremely expensive options, bought some cheaper options in implied vol terms, created this range that encapsulates where we think the stock will fall. But you see how specific we're getting here? And all of a sudden, we get a really good risk to reward trade. All I needed to do to be able to do this was determine what direction I thought the stock would go, come in here, look at the data to understand what the option market thinks is going to happen, and then structure out a trade, just like I showed you here, that expresses the difference between the two. Now, if you think these PA trades are pretty cool, stay tuned to the end where I'm gonna link you a video that shows you exactly how to structure out these trades. Weed stocks have been all the hype for quite a while now, and I by no means recommend that you put all your money into this. This is just a better way to speculate on the market, right? We're going from uncertain YOLO speculation to, okay, I have this idea. Here's what I think will happen. What's the option market saying? How can I take advantage of it? And using all of that information to put together a well-structured, well-defined position. There's a good chance that weed stocks will continue to rally into the future. We saw them take an absolute beating over the last 2 years, and now they're in a spot where maybe there's something there. Maybe this is the rally that people have been waiting for a long time. And if you want to speculate on that, we want to do it with a bit more certainty. We want to define what we're doing. We want to compare it to what the market thinks, and then we want to structure a trade to take advantage of it. So if you follow the steps outlined in this video and click the link that I'm going to put somewhere on the screen here, which shows you how to structure a PA fly, you'll be able to get a really good risk to reward betting on these weed stocks going up. We'll see you in the next video.